Good afternoon, everyone. Welcome to our webcast on short verticals. I'm Connie Hill. Happy that you joined me here today. You know, this is a strategy that some people really enjoy taking advantage of when they have an expectation in the markets. And so sometimes the market meets those expectations, sometimes it doesn't. But what if you had a way to determine that even if a strike price, even if maybe a trade was going against you and moving to your short strike price, if you had an idea that maybe it wouldn't actually expire there, wouldn't that help settle down the emotions you might be feeling as you're trying to manage that trade and you're seeing it go against you? We're going to talk about that today as we discuss some of our example trades that we put on last week. Now, I am joined in the chat by Mike Fairborn. I'm glad Mike's here. Good friend, fellow coach. He knows this strategy inside and out. So if you have questions, go ahead. Ask them. He's here to help me filter questions. If I can't get to it, or maybe it's a little bit off topic, Mike will help me out there. But I will keep my eye on the queue, make sure we get your questions answered. And there were a couple from last week that I didn't get to that I will answer here today. Now, I hope you're following both Mike and I on X. I am Connie Hill CS. He is Mike Fairborn CS, and we'll post educational content throughout the day. Things we notice in the markets that we think you might find interesting, we try to share those with you. So take advantage. It's free to do and pretty easy as well. Let's go through our disclosures and jump into our agenda. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended to be educational and just training type information. Don't consider it a recommendation of any sort. We will be using the Paper Money software application. This is what you download to your computer screen or to your computer. It's the most robust version of Thinkorswim. If yours looks a little bit different, you might be using the web version of Thinkorswim. Investing involves risk, including the loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. That is a really important thing to understand with short verticals, because there's always that possibility. One thing that's different in Paper Money is it will not assign early. Live market, man, you could easily get assigned early, but Paper Money doesn't do that for you. And so just don't think that that's how everything works in the real world. Know that there's that difference. Past performance of any security or strategy does not guarantee future results or success. Now, I do like to talk a little bit about some of the concepts of short verticals as we get started here. This is an intermediate level class, but if you're somebody that's newer to short verticals, I want you to be able to follow along. All right, so we'll be teaching some concepts in here as well. Talk about how do you manage these trades. Last week, we just put on 3 new ones that we'll be able to monitor this week. And I've got several examples lined up that I would like to show you as far as maybe some newer opportunities. And I would encourage you, if you are trying to learn this strategy, you might decide to do these paper example trades with me, so you can be following on, be in the loop throughout the week as different things develop with it. Now, a short vertical has 2 option strike prices that we use. One is, I'm going to call it a driver. And if you have familiarity with golf, and even if you don't, hopefully you'll follow along with this. The driver of the trade is the one that kind of gets us the most distance in golf. Now, I only pretend to be a golfer. I'm really not a great golfer, but I do like to hack at the ball. In any case, the club that's the biggest usually is the one that can hit the ball the furthest. And so it is called a driver in your golf clubs. Now, other clubs that you might use have a smaller head. They might be a putting club where you're just going to roll it along the green. And those are kind of your more finesse clubs. Yeah, their goal is to get you to the flag as well, but just kind of in a smaller way. And so that first strike price that we sell typically has a bigger premium, and we call it kind of the driver. Now, there's not an official investing term called driver, okay? Just want to give you that analogy so you kind of get the idea. If you're a golfer, hopefully you could follow that, or even if you weren't. Okay, the first one we sell typically is out of the money, and the one we buy is even further out of the money. And that second leg that we buy, The reason we're doing that is to help define our risk and control the risk. It's kind of referred to as a hedge lag. And so it's definitely an important part of the strategy, but there's a lot of ways you can place that hedge leg as well. All right, let's go out to our Thinkorswim. Let's take a look at a few things here. First place we're going to start is I want to look at just real quickly what the SPX is doing, what the NASDAQ's doing, because this kind of gives you an idea, hey, should we be looking for more bullish opportunities, more bearish opportunities? Where exactly, what is it that we're seeing? So here's the SPX chart. The blue line is a 10-day exponential moving average, so it's faster. It doesn't include as much time. The fact that it's exponential means that it's going to be a little bit more reactive, a little bit more wiggly in terms of moving up and down because it gives more weight to more recent time frames. This red line's a 30-day simple moving average. All the data points of those 30 days are given an equal weight. And you'll see it doesn't wiggle around nearly as much as that 10-day moving average does. Now on the S&P, you can see recently what we've been seeing in the market is we're seeing a little bit what? We're seeing a little bit lower highs, right? We see 3 here where the index ran up, didn't get as high up there as that initial one. And so we're starting to see some weakness developing in the trend. And then down here at the bottom, man, this 5860 area has been some really good, strong support for the index. And so we're finding that it's kind of in a little triangle type area, which it may continue to just kind of hang around in there, go a little bit sideways, consolidating until maybe it breaks over the diagonal resistance or breaks down below this support level here. That might give you the idea of, sometimes maybe using something maybe a little bit more neutral as it's in this consolidating pattern might be helpful. And that's where short verticals can be very helpful as far as a strategy that you utilize. Now, if we look at the NASDAQ, let's take a look at it as well. And it's doing something a little similar in that where you can see we're getting lower highs here. So we've got this diagonal resistance, some decent support there at what, 20,900-ish. So similar type thing. My white lines, you can see I've got a triangle going there. And we really want to see it break out before it gets to the apex. If we see it go one way or the other, well before it gets there, it's a stronger breakout versus if price is just consolidating here in a really tight range and it runs out of space, so it has to go up or has to go down, then it's really not that strong of a breakout. So that's what we're looking for. We're looking for the market to tell us what is next. And we might not see what is next until we start getting in some earnings reports. We're going to start a little bit with that, a little bit tomorrow, but mostly getting into next week, we'll be having a lot more news coming out as far as earnings and maybe the market being able to pick a direction. Now, first thing I posed to you was, would it help you to know if a trade was going against you, if it wasn't likely to expire there, even though it might go in that area and touch it? Could that help you manage your emotions a little bit better? I hope the answer for you is yes, okay, because it should help you. So let's do this. We're going to go over to our monitor tab, and you're going to see the 3 trades we put on last week. So we did AMD, which has a January 31 expiration. These 2 have a February 21st expiration. So quite a bit more time left in these, 43 days. This one only has 22 days. Now you can see we're down slightly on AMD, down slightly in DHI, and up in our MCHP. Okay, that one we're up. And all of them are just kind of little moves. They're not really that big of moves. We're going to use AMD as an example here. Now I'm going to go out and show you the chart on AMD. I'm going to look at some numbers. I'm going to kind of zoom in here. And when did we get into the trade? Well, we got in on the first trading day of January, which was the 2nd, which was this day here. And it kind of looked like maybe the stock was bouncing down off of a moving average here, which some people might like to use for an entry. Well, sure enough, what happened the next day? Stock went up, stock gapped up on this day. That was actually on Monday, where we had some real bullish activity out in the market. Probably noticed that the CES conference was going on. There was some news that was coming out, and so caused some activity in the marketplace. Now, when we got in here and it moved against us, if any of you are following along with this trade in your own account, paper trading account, you might have been a little bit fearful. You might have thought, that went against us. And then on Monday, it's like, oh my goodness, it is clear up here at our 130 short strike leg. Whoa. One thing you need to understand about options is sometimes they might go somewhere, but not necessarily expire there. So as we come over here to the trade tab, I've got my AMD options open. You can see this. Our short leg is right here. This is our 130 strike price. This column is the probability of it expiring out of the money. And then what I did here is I came in here and I did a customized column set. And I added to it probability of touching. Okay, just type in PROB. You're going to get your 3 choices. And I grabbed this and I brought it over as well because the probability of the option hitting a particular price is quite a bit different than it actually expiring there. So as we look at this row here, our option has a 71+% chance of still expiring out of the money. That means profitability in the trade for us. That makes us happy. But on the probability of touching right now, it's only about a 58%. But when that price shifted up there by our strike price, this probability of touching was super high. So what I've done is I loaded up ThinkBack. If you don't know ThinkBack, don't worry about it too much. It just tells us what closing option prices were on a given date. So I've changed the date to January 6th. That's the first day it popped up pretty good size against us. And on that day, here's our probability of expiring column. Maybe I'll just outline this one for you. At that time, at the end of the day, there was a 97% chance it was going to go hit 130. That's pretty high, right? That's kind of like, well, that's almost certain it's going to get there. Right? But it wasn't necessarily that high of a number that it was going to expire there. Okay, now since it's dropped back down, that probability of expiring out of the money has increased, right? Right now it's about 71%. But just know, just because the strike price goes there, it doesn't necessarily mean that it's going to, even if it touches, it's not necessarily going to expire there. So that can be something to help you out as far as, hey, I'm getting a little nervous on this position, something like that, that you can kind of bring up that information and take a look at it. Now, I will tell you this as well. That is all of the our strike prices. It kind of went against us on all of them. Okay, so our second that we're looking at that, let's see, which one should we do first? Let's do DHI, because that's the one that's down the most. Okay, so we take a look at the chart on DHI. And you can see I've drawn in here, yeah, major downtrend here, right? Here's our strike price, 145. It has not even touched it or gone near it. So the reason we're down on the trade is primarily due to yesterday's price action where it had a nice bullish candle here. But notice we're still far away from that short leg. So we're going to need time decay to kick in, time to erode the value of those options. And that's why these are called trades of patience, okay? Because it can take a long time for that erosion to occur. We collected our premium up front, which is something that many people really love about short verticals, is they get that premium up front at the beginning of the trade. We don't get that in other types of strategies. Long options, we got to wait till the trade's done. Stock trade, we got to wait till we actually sell it to realize that profit in the account. Okay, so just keep in mind that might be helpful for you to do is draw where your short strike is and know as long as it stays below it or expires below it, that's when the trade is in good shape. Now, let's move on to something else. I wanted to show you a couple of things here today. One was that probability of expiring and probability of touching. And the other thing was, you know, when you're looking for candidates, what can be a good place to go fishing? Well, we looked at what the markets were doing. We could be due for bullish trades or bearish trades, depending on what the major trend is. Now, I am going to copy over here into the chat the summary of principles we talked about last week. And I'm just going to paste them over. I just call these guidelines, which I spelled incorrectly. I've got to get an E in there. Guidelines for short vertical. So the first one's follow the trend. Whatever that predominant trend is, you want to follow it. Typically, we don't try to be counter trend traders because the probabilities decrease for us. Okay. We want lots of liquidity. And so, some people might look for 1 million as far as the stock trading, because that's likely to lead them to a stock that has a lot of trading activity on the options. So some people move it to 2 million. All right. And then deltas, high 20s to 30 something is a kind of a ballpark. Somebody asked a question about that last week that I didn't see until our class was over, and it was Jake. So if Jake's here, we're going to answer your question. It was a fabulous one. He said, the time frame, 20 to 40 days, why are we choosing that? Or why is it a good time frame to work with? He says, does it give you a better advantage over shorter or longer time frames? And the answer is the 20 to 40 days is in a time frame where that option is starting to decay more rapidly. An option that, say, is 4 months out, it's not decaying all that much every day. But the closer we get to the option's expiration date, that's when we see the greatest impact of time decay. So if we go sell 4 months worth of time, then it's really going to be a trade of patience, right? Because you've got a long, long time to wait before that time can decay. It's just so slow. So that's why many people like a shorter window. Now, sometimes you might be smaller than that window, right? You might say, oh, I see something that looks ideal that has 15 days left to expiration. Okay. And if it makes sense to you, if it follows your rules, some people might use shorter time frames. And I'm going to say, or somebody that's trading more aggressively maybe has a little bit more experience and has experienced time decay, so they know kind of what that's going to feel like. The only way you get an idea of how something's going to work is to actually go out and place some practice trades out in your paper money account. Next up, Daniel had a question, and I'm going to answer your question right here, Daniel. Daniel said, how many trades can you have going on at once? And I'm going to say it's an individual preference, how many trades you can do at once, how many you want to do at once. I talked to an individual once, and this is no exaggeration. I can't remember the exact number, but it was like between 75 and 80 trades he had on all the time. And I said, how can you possibly give them enough attention to maximize your profitability on all of those trades? And he didn't really have a good answer for me, but in my mind, I was thinking, man, that is way more than I would be willing to do. Okay. I do not have that much time to look at 75 or 80 trades every single day. Okay. Now, for you personally, you might find, that 3 trades is all you can do right now. And that's fine. Just do 3 trades. It doesn't mean we load up on our risk. We don't want to, risk more than what we should. Okay, but you're going to get a feel for what you can handle. And I have to be honest with you, I have overtraded at times and was not able to devote the kind of time I needed to those shorter term type trades, which a short vertical is. Okay, so to answer that question, it's going to be up to you to figure out where your happy balance is. All right. Let's see what Bruce is saying here. But if Barbara, I'm actually Connie, but you say if I sell an in-the-money option at expiration, I can't cover the underlying. How do I close the option for a gain? Bruce, that's really beyond the kind of what we're planning to talk about here today. We're talking about selling out of the money options. We're not talking about selling in the money options. Okay, so we're selling our strike price out of the money. Okay. Hopefully then you'll like, okay, that resolves your concern. It's not going to be in the money. It's going to be out of the money. All right. Trying to find trades that are interesting to you that you might want to trade. I'm going to show you two different things here today, and we're going to cross them together. First, both of them are going to be under the Scan tab, and we are going to start with, we'll start with SpreadHacker. I don't mind starting with SpreadHacker. If you don't know this tool, what I might say to you today might feel a little overwhelming with like, whoa, that's a lot of data and information, okay? And I get that. That very well could be the case. However, let me just show you how you can use it. SpreadTracker basically goes out and crunches numbers for you, okay? And so we're going to give it some guidelines and say, go look for stocks that meet this criteria and bring me back things that meet it. It doesn't know anything about technical analysis. It doesn't know anything about entries. It doesn't know if you intend to get into a trade or not, right? That's going to be up to our rules and what we're looking for on a chart. It's just going out, running some numbers for us, okay? So in our SpreadHacker, I've got 4 things up here right now. So underlying price, I'm going to say we're going to use a minimum of 40. In downward trending stocks, it can be a little bit tricky when the price of the stock gets too low because maybe it's already dropped a whole bunch and there's not a whole lot left for it to drop anymore. Okay, so 40 bucks is where we're going to start that. Probability of profit, we're going to put in a range here. We're going to put in a range from 60% to 85%. Now, what does that mean? It's saying, what's the likelihood of this option expiring out of the money? Okay, and we're kind of have a balancing act that we're running there. And so we're going to go in that range 60 to 85. Somebody's asked before, why not stick 100 in there? You could if you want, but it's not likely that it would meet other parameters of meeting and giving us a minimum return that we want. And that's what this next line down is, your max profit. So it'll go crunch the numbers for us, and we're saying, hey, we want anywhere from a 25% to a 55% return. It's not very common to get things well beyond 50 or 55%. That still are a high probability trade of at least 60%. Okay, so we're just kind of fine-tuning some numbers here. And then I have days to expiration. You don't have to put days to expiration on if you don't want to. I'm going to give us a shortcut here today, and that is that we're going to make it focus on options that have 43 days to options expiration. Why are we going to do that? Number one is because sometimes these weeklies are not super liquid. And I tinkered with it a little bit today and went back and forth and really had more success at finding things that kind of gave me the optimal with just looking at the February 21s. When it came back and it returned other ones. Now, AMD is an exception. It traded 46 million shares yesterday. Okay, so it has a lot of trading activity, but a lot of the other ones that it brought back, we just went very thin options. And so you're kind of like, well, I'm just going to go down to February 21 anyway. Okay, so 43 days worth of time. In the spread, we're going to kind of isolate it. We're going to say, okay, look between 42 and 44 days worth of time. That means, and you can see the results I'm looking at here, February 21, every single one of these, okay? So that's the reason for it. Again, you don't have to use it. Now, Dragon says, well, why are they all in red? They're all in red. The other part that you need to know up here is what I'm searching for. We're searching for verticals. We could use it to look for other types of strategies. That's not what our class is about. So we are doing vertical. And they're all seem to be what? They seem to be credit spreads. I don't think there are any long verticals in here. It's possible that a long vertical could come on and it would have a green background. However, typically you need, for you to successfully use SpreadHacker here, you might need to use a little bit different parameters than what I've got here. Okay, so that's why they're all red. Okay, looks like we've got that answered. Appreciate that. Thanks for helping me out there as well, Mike. Okay, so now we've got a whole bunch. I said show me 200. That's kind of a lot to sift through, but I'm going to leave it there. Okay, and I also said on this particular one, I said run it on the NASDAQ 100 stocks. Okay, this is just from a public watch list. Come down to the ends. It's the very last one on the ends. NASDAQ 100. So it's only going to look over 100 stocks. That's all it's going to look for. Does the NASDAQ, do you have to use the NASDAQ 100? Absolutely not. You could use nothing. You don't have to intersect it with anything. But I'm, again, trying to boost our odds of maybe finding some stocks that do a lot of trading so that we can find liquidity in the options. Now, this particular one, I've got a couple in mind that we might be able to use here. And the first one we're going to look at here is Google. And actually, let me hit scan again. The number should be exactly the same because the market's closed right now. This is on a day when the market's closed. I'm going to scroll down to the G's. And I want you to notice a couple things. We have Google without the L. It's bringing us up maybe 3 for this. And then we have Google ending in the GL. Okay. Most of the time, these are very similar in terms of what the price looks like on the chart and what the trading price is. They're pretty close to each other. And both of them have a lot of trading activity. One is non-voting shares. With options, we don't get voting privileges, so it probably doesn't make a big deal to us, okay? But one thing that's interesting as I examine the results of a spread hacker here is one that was coming up that was a 68% probability with a 43% max profit. Does that fit our guidelines? Absolutely, man. It fits them perfectly, okay? And then I noticed, well, what if I looked, and this was 205, 210, and I wondered, did it bring back a 205 or a 210 for Google with an L? And it did. Interesting, this one is giving a $1.30 or a 35% max profit potential. And the one without the L, it actually is a little bit higher, a $1.52, which here is showing about a 43% return. So, a little bit juicier of a return here might make somebody decide, hey, I'm going to go with Goog and not Google, right? Simply because of that. Now, it probably isn't a huge difference, okay, but we can see it's crunched the numbers for us. Great. We're going to go out and look at Google. We're going to look at the Goog, right? We're going to look at 205, 210. So as we come over to the trade tab, let's go ahead and type it in here. Oh, without the L, Connie. Yeah, rid of the L. There we go. Today it traded over, or yesterday it traded over 14 million shares. We forced it to go into the February options. I will tell you this, initially when I was looking at this, one thing I did note is these weeklies are actually pretty liquid. So if somebody wanted to venture out from there, say you're looking for a short put vertical, these numbers aren't that bad. But if you're somebody that trades, likes to trade 20 contracts at a time, 30 contracts, you might not have enough open interest here that you'd say, I've just got to go down to the February options anyway. Okay, but look at the thousands. Whether we went with a call spread or a put spread, we've got thousands to work with. Now we've pulled out for us the, let's see, 205. Let me go back here to our scan. Make sure I've got the right one. We're going to look for a call spread. A put spread. I apologize. On the put spread, I was pointing out the call spread to you, which would have been bearish. I'm going to bring up the chart for you real quickly. Here you can see that overall it's been quite bullish. Some technology stocks have broken down. This particular one still pretty decent, got a nice little bounce there yesterday. off the 10 period moving average. Some people might like that for an entry. Bounces make entries people like, holds. Also, sometimes just sitting at a support. Sometimes people like to enter into a spread trade, even if they haven't seen a manifestation that maybe it's going to go up. Okay, because it's sitting at support, we expect it to jump up, but some people won't wait for the actual move. Okay, so the strike price here, if we're going to go for the put, let's see, the 185, 180 here was a 34% return. And the same strike price, 185, 180 here, is a 37% return. Okay, so slightly better on this one, on the one with the GL. Okay, so let's go back to here. We're going to put the L back in. And 185, 180 was the spread that it gave to us. So it already kind of did the math. Okay, we're going to do sell vertical. It's going to go grab our strike prices that we want. And it's saying about a $1.36 return. If we go back to our scan, it should say a $1.36 here. And of course it does. It's telling us based on midpoint prices. Okay, so we know it has a 37% potential maximum profit. It's not going to be any greater than that. And the probabilities are starting out above 60. And typically that's what we'll look for a higher probability trade, and why we stuck that minimum number right there in the scan. Okay, we can risk in this class, I'm allowing us to risk up to $1,000. Now your account might be different. Okay, your account might say you can only do 1 trade or 2 trades. If we're willing to risk $1,000 per trade, then we have to figure out what our risk is. So $5 minus our 136 is going to tell us what our risk is. Let's just do that real quick. 1.36. So 364 would be our max theoretical loss if everything in the world went wrong in this trade and it expired in the money and we went to sleep. Okay, that's our maximum loss. Now, because if we got 3 contracts, that would put us over the 1,000. We're just going to do 2 contracts here. All right. We can put in an opposite order here, which I like to do. Let's do a first trigger sequential. Let's create an opposite order. And here is where we're going to say, you know, if we get a good sized chunk of that max profit, let's go ahead and get out of the trade. Let's buy back the spread, stop our obligation, and then we'd be taking the net of whatever we buy it back for. So 136 minus whatever we might put back here. So if we get, let's say in this case, 70%. We get 70% of a $1.36, then only 30% is left. So our quickest math is to multiply it by 0.3. Sure, hit the right key here. So that says go buy it back at 40 cents. Okay, we'll go buy it back here at 40 cents. And we would be happy to get a chunk of it. And there we go, get a chunk of it and be on our way. Now, some of you may be used to squeezing everything out of your tube of toothpaste. Man, you are a good squeezer, okay? That might not be the way to trade spread options, though. Spread options might be, hey, we get 70%, 80%, whatever you think that number is comfortable for you. If you get that, you're like, I've got most of it. I'm going to be done. Don't be like your toothpaste, where you're very efficient at getting every little last bit out. If you're anything like me, I'm a big pusher on my toothpaste. All right, we're going to make this good till canceled, and we're going to send it in, and we're going to go ahead. We're going to put it in our short verticals bucket. All right. Looks like something, trying to see that you're not maybe seeing something. If you're trading a vertical over earnings, you might be asking for trouble, is what DJK says. You're absolutely right. We want to be cognizant of expirations, of earnings announcements. So I had this put out, my window to the right, about 20 days. Okay, that gives us a month. Can some of these trades be done in 4 weeks? Absolutely, right? Even though we're buying an option that expires February 21st, we're not planning to be sitting there February 20th. Okay, we're planning to be out of it early as soon as we get a reasonable chunk of our credit, or if it has a major technical reversal on it, we might have to get out early for that reason as well. Okay, so absolutely, I've got it right here. They're not going to be until February 4th. Okay, so yeah, we have about 4 weeks to be in the trade. Thank you for bringing that point up, because that actually was somebody else's question from last week as well. Now I'm going to come back to our scan, and I want to do a bearish trade. And that would mean we're going to be looking for what? We're going to be looking for call options here. However, I'm going to put a little angle in here. The little angle is, I want to show you, let's go over here to Stock Hacker. And in Stock Hacker, I created something to build a watch list from. Okay, this is maybe another approach some people might use. Again, take notes, right? I'm going to go through this pretty quick. Looking for stocks that are at least 40 bucks. And we're looking for average volume here of 2 million. And then this stock's got to be downward trending. So we're looking for it to be at least down 15% in the last 40 bars. Okay, basically 2 months, and down 5% in the last month. So we're definitely looking for downward trending stocks. I went ahead and I hit the scanner here, and I got back a whole bunch, but some of them ran into earnings. Okay, so I added this last parameter here. So under the study filter, I chose earnings. And then you get a choice. It has or it doesn't have. And I said, does not have an earnings announcement anytime. And I said in the next 3 weeks, basically. Okay. That's what 15 bars is, essentially 5 trading days, 3 weeks. Okay. To give us a kind of a reason for this, or the ability for the stock to move and make the move before it actually ran into the earnings dates. Okay. Then I saved this as a watch list, and I called it, oh, it's not going to show us here. I called it today's date, Bears, NE for no earnings. Okay. So I used the scan, built that, saved the watch list. Now, as we come back here to our stock hacker, or to our spread hacker, then we're still looking for verticals. We're not going to look over the NASDAQ 100. We are going to look for a personal watch list. And first one I did was just today's date. This one was NE for no earnings. And then it's only going to run it over those few stocks that we found. Okay. Again, I've still got it sorted at 200. And then we get a lot of results back. Again, they all meet this parameter because it went and did the thinking and the number crunching for us. Okay. So a couple that we have here that look like maybe possible opportunities looking at things bearishly. The first one I'm going to look at is CBS. Now, CBS, it gives us actually several possibilities. It gives us both some call spreads and put spreads, which is interesting. Just the idea that you're like, why would it bring it back a put spread that's bullish in a downward trending watch list? And the answer is because it met the numbers. It crunched out the numbers that we were looking for. Okay, what we're going to do here, we're going to do the 42. Let me make sure no. We are going to do, I think I changed this one. Let's come out to our February 21, and let's go to our 40. Let's see if we have our 47.50, a $2.50 wide spread, but it has a 64% probability of expiring out of the money and about a 46% return. Okay, let's go look at that. That's 47.50, 50 on the call side. And let's see here. Here's our 47.50. Now it meets the criteria that we told it, but it's at a 44 delta. And some people might not be comfortable at a 44 delta. Okay, so if you are one of those people, you would probably say, I'm going to keep looking. Maybe I'll choose a different choice. Maybe I'll choose a different strike price that maybe is a little bit further out of the money. Okay, and let's see if this gives us 47.50. No, this is giving us some puts up here. Okay, here's 50 and 52.50. So it'll give us a 25% return, but we start out with a 73% probability of success. Okay, so the teeter-totter kind of went up on the probability side and down on how much of a return we might get. Okay, so we're going to go ahead with this one, the 50, 52.50. All right, might be more comfortable there for some people. And we're going to do sell vertical. Oops, I must have hit buy. Sometimes my mouse slips. And so we're going to get a 50-cent credit. So that's our max theoretical gain. We're not going to earn any more than that. We're going to risk basically $2. Our $2 will be on max theoretical loss. Okay, so we're willing to say, okay, less credit, higher probability. Okay, on this, since our theoretical max loss is $2 per contract, we can do in here 5 contracts. So we'll do 5 contracts here. We'll do a first trigger sequential, so we can put in our opposite order. We don't want to analyze it, we want to create it. And then when we get a chunk of our 50 cents, we're going to get out. Okay, again, let's go 50 times 0.3, because when we get 70%, there's only 30% left. That says go buy it back for 15 cents. We'll adjust that. 15 cents, make it good till canceled. And we're going to hit confirm, put it in our verticals, short verticals bucket where we're tracking stuff. Oh, well, that's interesting. Paper money filled us today. Usually it doesn't fill you when the market's not open. However, it looks like it just did it. Here, I saw it do that earlier in a class I was doing the chat for. Okay, so we got filled on that one. So we have 2 more in our bucket that we're going to monitor. And I'll look for Google to get filled tomorrow as well. Now, Monday says, what would be the best scan short criteria? In terms of the scan in StockHacker, there's quite a few different possibilities that it could be. I was really focusing on, hey, getting those downward trends, stocks that are losing money, and then running it through our spread hacker after saving that watch list. Okay. Yeah, it really does depend on your personal preference. If you go for higher return or higher reward, or you're just trying to find the right balance for you personally. All right. So what do I want you to do? I want you to go practice this strategy. If you want to use those spreads and you have that comfort level with the spread hacker and StockHacker, like I showed you, great. Go find some examples. And again, in your paper money account. It's very important you do this as you're learning strategies. And if you want to follow along on the strategies that we're doing as example trades in our class, go ahead, put those in your paper money account as well. Because then when we're discussing trade management, we might answer a question that you had during the week. All right, we will be back next week, follow up on those trades. I hope you're a subscriber, right? That makes it so much easier for you to find our content. If you subscribe, just click on that little YouTube button that's blue in the bottom right-hand corner of your screen. All right. Yeah, I did not see a survey out there today, but if you found this useful and helpful, go ahead, give us the thumbs up button. That'll help others find the content as well. It improves what's going on in the algorithm with YouTube so that others can find it. You might be doing a stranger an awesome deed. And then Mike and I would love for you to follow us on X. All right, we'll be back tomorrow. The markets will be back open. We'll be there bright and early, 9:30 Eastern time. Thank you, Mike, for your help today. We'll see you tomorrow. Bye-bye.